Now that we have had an introduction to what is a company, what are its different kinds, and also what is share capital and its different kinds, now let us discuss the procedure of issue of shares and accounting treatment on issue of shares of a company. When a company issues shares to raise capital for the company, it collects the amount on its shares in installments over a period of time based on the growing financial needs. While issuing the shares, a company has to follow a set procedure. First and foremost, the company invites the public by letting them know that a new company is formed and is calling for funds. The invitation that is issued to the public is called as prospectus. It contains all the information that the public needs to know about the new company, like information about the company and manner in which the company wants to collect money from the prospective investors. Once the prospectus is issued, the prospective investors who want to subscribe to the company's shares make an application along with the application money, which is deposited in favor of the company in the manner that is stated in the prospectus. If the minimum subscription is received on application, that is, a minimum amount which the directors state to be compulsorily required to meet the immediate needs of the company, then the company proceeds with the allotment of shares to the subscribers to whom the shares are allotted. Once the shares are allotted, it represents a contract between the company and applicants for shares who are now termed as shareholders. The process of issue of shares involves firstly the receipt of application money from prospective investors, which is transferred to the share application account. Thereafter, shares are allotted to such investors and the allotment money is received. These are two separate processes, but in some cases, a single account called share application and allotment account is opened for accounting the money received on application as well as allotment. Once the application and allotment stage is done, then finally calls are made for having the shares fully paid up and for realizing the full amount of shares from the shareholders. This sums up the process of issue of shares. Out of this process, in this video, let us discuss the first step of the process, that is accounting treatment on application of shares. When a company issues shares, the amount is collected in installments, that is an application stage, an allotment stage and a call stage. The amount received towards the capital of a company should be credited to the share capital account. However, firstly, the amount received in any installment is first credited to the account representing such installment and then finally credited to the share capital account. This helps in recording how much amount relates to each installment in the process of issue of shares. The money raised at the time of application should be at least 5% of the face value of shares. At the application stage, the company has a right to accept or reject certain applications since receipt of application money does not signify a contract between the company and the subscribers. When a company receives money on application, the same is accounted by debiting the bank account with the actual total money received on application. The corresponding credit is given to the share application account, which is opened to account for the money received on application. The bank account is debited since company receives the money, and the share application account is credited to account for the money received for share application, which will then be transferred to the share capital account.